Hey guys, this is a quick video. So there's a full video that goes through the entire concept of the child's whole life, infinite banking. This is a shorter video just looking at the illustration and what numbers you can expect. If you haven't watched the other video, I highly suggest you watch that one. If you have watched it, you've probably already seen this illustration toward the end of it, but this is just so that you can just see the illustration. This is my daughter's policy that I made for her. So like I mentioned in that video, I tell everybody I do not like talking about life insurance for children in the sense of using it as life insurance. Even though this is life insurance, I don't use it like that. I designed this to be a bank, pretty much a family bank for her that I'm going to give her when she turns 21. I don't like to have the conversations. You could argue that they need to be had. Somebody needs to do it. I don't like to do it. I could and get paid to do it, but I don't want to. I just don't feel comfortable having those conversations, having a kid myself. But I love to talk about using whole life as a banking system for your child. I freaking love it. The first time that I heard about life insurance for a child, my first reaction was that I'm not even going to consider it, don't want to think about it. That's before I found this out. When we're looking at this, so we have two columns, we have guaranteed and we have non-guaranteed. So the guaranteed section is pretty much if this company goes belly up, out of business, these are the numbers that we're going to get. And that's less likely than the non-guaranteed because this company has been in business for over 100 years. And they've always paid a dividend every single year through every depression, every recession, every economic downturn, every war, whatever happened, they paid a dividend. The chances of them going out of business isn't very likely. They just can't, they just have to show that part. Over here, you see the non-guaranteed assumptions. This is based off of the current dividend scale that they have, and they have to say it's non-guaranteed, but really this side is more likely than the other side because they've paid a dividend every single year for over 100 years, for nearly 120 years. So you tell me which one's more likely to happen. With this policy that I've set up, this is the policy that I got for my daughter, Stella. She's $2,000 a year. You see, so here's the contract premium. I like to call it a premium deposit because I'm depositing it into her family bank that I'm going to give her when she's older. This is the increase in cash value right here. Now, I want you to pay attention to this column here, because remember, are we doing this for immediate benefit or are we doing this for long term? If you're setting something up for your child, we're looking at long term. Let's look at what it starts looking like long term. So just at year 6, this is what I like to call the singularity. What happens here in this example is at year 6, I put 2,000 in and I get more back for what I put in. It's a singularity. At this point, every year, I will get more back than what I put in, and it will keep going up forever. Okay? It'll never go down. 2,000, I put 2,000 in, I get 2,067 back. The year after that, I put 2,000 in, I get 2,172. It's not even an expense anymore. I'm making money immediately every time. Every year, you see, like on the 10th year, I'm getting a 25% immediate return on that money. Now let's scroll down to 21, because that's whenever I'm giving this to her and she can pay her own bank, and I'll stop paying it for her. So she's 21 years old. This is the 20th year in the policy. She puts $2,000 into her family bank that I've just given her, and she gets almost $3,800 immediately increase cash value that she can use for whatever she wants. That's almost 100% return on your money immediately. She has almost 50 grand at this point that she can use to finance a car, go to college, put a down payment on a house, whatever she wants to use it for, she can use it. I'm 30 years old. Let's go down. Let's check out what it's looking like when she is 30 years. At this point, when she turns 27, the premium goes down to $1,000. At 30 years old, so just 9 years later, she puts in $1,000 and she gets $4,200 back, almost $4,300. That's over 4 times her money. This is an asset. It can't go down. It only goes up. This is not being used as life insurance. It doesn't even look like life insurance right now. I don't design them to, like, there's a death benefit over here, but we ain't worried about that. But I mean, it will be beneficial for whenever she gets older and she has a family, a husband, and her own kids. She has insurance for life, so that is a benefit. Look and see what happens whenever she's 50, okay? She's 50 years old. She puts in $1,000. She gets $10,000. And she has $225,000 of cash value she can use. At 50 years old. There's people that are 50. My grandparents raised me, and they're mid to late 60s. They could have afforded $1,000 and they would have had this. But you know what they have? Hardly anything. Like my entire family behind me is I mean, we would be considered poor. And not to get into my story, but that's why I like this kind of stuff, because I don't want that for Stella. Like my whole goal has been, from me on, my family's trajectory is changing. You might be listening to this because you have the same mindset. That's why I love this stuff. This is how you create generational wealth. This is how you leave a legacy. She's 50 years old. She's getting 10 times her money that she puts in. That's insane. I'm 70 years old. She puts in 1,000 and she gets 22 grand back. That's insane. Like this is why I love this stuff. Like you can set one of these up for your child, and you've given them an asset that's going to continue to serve them for the rest of their life. Look, 70 years old, she puts in 1,000, gets 22 back. She has $540,000 in cash value that she can use for whatever she wants. You can actually, I haven't done the math on it, but for probably about 25 years, you could start getting tax-free probably about 80 to 100. I don't want to spit out numbers because I don't want to be wrong and get roasted, but you can use this as tax-free retirement income. Look, when you get down here at 86 years old, it just gets crazy. Look how it's exponentially getting bigger. Just like the whole penny doubles for every 30 days thing. At day 20, it's only $5,000, but at day 30, so it's 66% of the way through, and it's only $5,000, and then at day 30, it's 5.3 million. Like what happened? It's because later on, this stuff gets crazy. So at 85 years old, she puts in 1,000 and she gets $35,000 back. Now she has almost $1 million. At 86, she'll have $1 million in cash value. It's crazy. And then at 95, every year after that, she doesn't have to pay anything. Even though she's not paying anything, she's getting $45,000, almost $46,000. She's paying zero. Again, it's whole life. It's a life insurance product, but we're not using it like that. We're using it as a banking system. She's gonna have kids, and look at this death benefit right here that she gets. That gets paid out to her kids completely tax-free. What I've done and what I can talk you through is you set up a trust to be the beneficiary. The trust buys more life insurance on everybody in the family. It just keeps the thing going. So every generation you get wealthier and wealthier, and it just protects it from, I know there's going to be somebody in my generation that's just going to be stupid and waste their money. So I would like to protect my money from that person. I would probably have been that person in my early 20s that would have blown the entire generational wealth from 100 years. I would have and probably killed myself by doing it. Because if you guys have any questions, if you're watching this video, you have questions, just reach out to me, shoot me a text, give me a call. I would love to help you. This is what I love doing, setting up this family bank for their children. Like, because I'm a father myself, this is what I love to do. So I'd love to have the conversation with you, and I'll talk to you soon.